Bitcoin is trading at approximately $65,500 right now, down somewhere between 0.5% and 1% over the past 24 hours, moving inside a tight band between roughly 64,950 and 66,700. That is not a crash. That is barely a shrug by Bitcoin's own historical standards. And yet, scroll through crypto Twitter, crypto Reddit, or the comment section of literally any Bitcoin video posted in the last 24 hours, and you would think the network was on fire. One comment asks, in essence, if Bitcoin is about to hard fork, and whether holders will keep both resulting coins if it does. Another comment frames the entire holding experience as a binary trap. Sell too early or become the story everyone else wishes they had copied. And a Czech language comment, translated, says something that does not even need translation to land emotionally. Every time Bitcoin creeps up a little and then slides back into red, the hangover hits. Kokavina. That is the actual word being used by actual holders right now to describe how a completely ordinary, boring 0.5% red day feels in their stomach. Here is what makes today specifically worth stopping on. While retail sentiment is doing all of that, spinning between fork panic, sell too early anxiety, and dip fatigue, US spot Bitcoin ETFs pulled in another $69,280,000 in a single day. Roughly 1,064 Bitcoin, extending a streak of inflows that has now run for 7 consecutive trading days and pulled in close to $1 billion since the middle of July. Retail is anxious about a fork nobody asked them to vote on. Institutions are buying on the same day at the same price. This video is going to walk through exactly what is driving both sides of that split. The specific fear circulating among holders in their own words, the specific institutional flow behind it with a number and a source, what 2 of the accounts most holders actually follow posted about it in the last 24 hours, and the one honest question this contradiction leaves you with by the end. Let's be precise about what is actually happening today before we get into any of the deeper analysis, because precision is the entire point of this channel. Bitcoin sits close to $65,500 inside a range of roughly $64,950 to $66,700 over the past day, a move of less than 1% in either direction. That is, by any reasonable definition, a quiet day. And quiet days do not normally produce fork panic and existential holder anxiety. So something else is doing the work here, and it is worth naming directly. It is not the price today. It is the accumulated weight of everything sitting underneath today's price, the fork drama scheduled for next month, the memory of a much larger drawdown earlier this year, and the specific psychological toll of watching small green candles keep turning back into small red ones. This video is not going to tell you the fork fear is irrational, and it is not going to tell you the ETF flows guarantee anything about where price goes next. What it is going to do is separate the parts of today's story that are genuinely new information from the parts that are simply old anxiety wearing a new headline. Before we get into the specific fear circulating right now and the specific institutional number behind today's ETF flows, I want to point you towards something, because today is exactly the kind of day this tool exists for. It is called the Bitcoin Holder's Bible, and it is built specifically to answer the question you are probably actually asking underneath the fork panic and the dip fatigue. Is what I'm feeling right now supported by data, or is it just how a quiet, boring day feels after watching a chart for too long? It walks through exactly how to read ETF flow data, on-chain accumulation signals, and fork or protocol level noise like what is circulating today, translated into a 5-minute weekly check. So you are working from the same information seasoned holders. Check on a schedule instead of reacting to whichever comment thread you happen to read first this morning. The regular price is $97. I'm not going to give you the discount code yet. Stay with me through the rest of this video because there is a specific $50 off code waiting for you at the end, one that brings the price down to $47. And by the time we get there, you will have seen the actual data behind today's specific split between retail fear and institutional buying. For now, the link is in the description if you want to look at it while we keep going. Let's get into what's actually happening. Start with the number itself, because it deserves to be stated plainly before anything else. Bitcoin is trading at approximately $65,500 as of today, with a 24-hour range running from roughly $64,950 at the low to $66,700 at the high, a move of somewhere between 0.5% and 1% to the downside on net. According to reporting on the broader July price action, Bitcoin reached an intraday high near 66,300 just one day earlier, meaning today's pullback is a retracement inside an already established range, not a break of anything. Here's the context that matters more than the number itself. That same reporting documents that Bitcoin had been climbing through most of July, reclaiming levels above $65,000 after a rebound from lows closer to $63,700. With the broader move connected to the same 7-day ETF inflow streak this video is about to walk through in detail. In other words, today's small red candle is sitting on top of roughly 2 weeks of net upward movement, not underneath a fresh breakdown. That framing matters because of how loss aversion actually works, a mechanism this channel has covered before and will come back to later in this video. Your brain does not measure today's red candle against where the price was a month ago during a much larger drawdown. It measures today against the most recent high it saw, which for a lot of holders right now is that 66,300 level from 1 day earlier. A drop of under 1% from a recent local high registers, psychologically, as meaningfully worse than the same drop would feel if it had happened from a flat, unremarkable stretch of price action. The chart is calm. The nervous system reacting to it is not calibrated to calm. It is worth stating plainly just how narrow today's actual trading range is, because the word volatile gets attached to Bitcoin so reflexively that a genuinely quiet day can get swept into the same emotional category as an actual crash. A range of roughly $1,750 from $64,950 to $66,700 on an asset trading above $65,000 is a band of under 3% from low to high across a full 24-hour session. By the standard of Bitcoin's own trading history, including moves of 5, 10, or even 20% in a single day during genuine periods of stress, today's entire range would barely register as a rounding error. The mismatch between the size of the actual price move and the size of the emotional reaction circulating around it is, on its own, one of the more interesting data points in this entire story. None of this means today's pullback is meaningless, or that a genuinely larger correction is off the table. A market that has been climbing for roughly 2 weeks on the back of an ETF inflow streak is also a market that has more room to give back if that streak breaks, and a string of green days followed by a red one is not, on its own, evidence that the uptrend is intact. Reading a small daily move as automatically benign is its own kind of bias, just pointed in the opposite direction from panic. Now let's look directly at what holders are actually saying right now, because the specific wording matters more than a generic summary of sentiment is negative. The first fear circulating is about a fork, and it is not coming from nowhere. One comment making the rounds asks plainly, "It looks like Bitcoin is likely headed for a hard fork, and if that happens, will you hold both resulting assets?" That question has a real, documented basis. According to coverage from Cryptopolitan, Prime XBT, and Pickaxe published across July of this year, Bitcoin is currently facing 2 separate, unrelated protocol-level events, both targeting activation in August. P110, a contested soft fork proposal designed to restrict how much arbitrary, non-financial data can be embedded in a transaction, and a separate, genuinely structured hard fork called eCash, backed by drive chain architect Paul Stork, scheduled for a snapshot near block 964,000, expected around the 21st of August. These are 2 different mechanisms with 2 different purposes, but from where most retail holders are sitting, they land as one undifferentiated signal. Bitcoin's rules might change soon, and nobody has explained clearly what that means for the coins already sitting in their wallet. It is worth being precise here, because precision is exactly what is missing from most of the fork discourse online. P110 is a soft fork, meaning it tightens existing rules without breaking backward compatibility. And as of the most recent reporting, miner signaling support for it sits under 1%, according to CoinDesk's coverage of the proposal's decisive window. The eCash event is structurally different, a genuine hard fork that does not require Bitcoin's approval to exist at all, more comparable to a snapshot airdrop than a network splitting event for Bitcoin itself. Conflating the two into one generic Bitcoin is forking narrative is understandable, given how the headlines have been written, but it is also precisely the kind of imprecision that turns a manageable, well-documented protocol event into a source of vague, undifferentiated dread. The second fear circulating is not about protocol mechanics at all. It is about psychology, framed as a binary choice. Every Bitcoin holder has 2 choices: sell too early, or become the story other people wish they had copied. That specific framing is worth sitting with, because it is doing real emotional work. It takes the fear of missing out and the fear of losing money and fuses them into a single, inescapable trap, where holding feels risky and selling feels risky, and there is no version of the sentence that ends with the holder feeling calm. That is not a data-driven observation about Bitcoin. That is a description of what anxiety sounds like when it puts on the costume of market wisdom. The third fear is the quietest and in some ways the most honest. A Czech language comment, translated directly, describes the exact bodily sensation of watching Bitcoin creep up a little and then slide back into red. The hangover hits. That single word, cocovina, describes something real and worth naming directly rather than dismissing. It is the specific fatigue of hoping a green candle means something, watching it reverse, and feeling that reversal in your stomach rather than in your spreadsheet. That is not weakness. That is exactly the mechanism. Section 5 of this video is going to name precisely, because it has a name, and understanding the name is the first step toward not being run by it. Naming a fear precisely does not make the fear invalid. The BIP 110 and eCash events are real, scheduled, and imperfectly understood by a large share of the market, which is itself a genuine source of uncertainty heading into August, independent of anyone's emotional reaction to it. A holder who is confused about custody, exchange support, or whether their specific wallet provider will honor a snapshot has a legitimate practical question, not just an emotional one. And this video is not a substitute for checking your own exchange or custodian-specific policy on both events directly. Quick pause here, because everything in the rest of this video connects directly to what you just heard. The gap between a real, scheduled protocol event like BIP 110 or eCash and the vague, undifferentiated dread most people are actually feeling about it is exactly the gap the Bitcoin holder's Bible is built to close. It is not a fork explainer. It is a framework for checking whether a specific fear, whatever it is this week, is backed by a specific number, or whether it is simply the cocovina feeling looking for a headline to attach itself to. I still have not given you the code. I'm holding it for the end of this video on purpose, because the next section covers the actual institutional number behind today's price action, and that number matters more than the discount does. Let's keep going. Here is the specific number sitting underneath all of the fear covered in the previous section. According to Look and Chain's on-chain tracking published today, US spot Bitcoin ETFs recorded a one-day net inflow of approximately 1,064 Bitcoin, worth roughly $69,280,000. That is not an isolated data point. According to Sentiment Intelligence data reported by Benzinga, this specific inflow extends a streak of 7 consecutive trading days of net inflows running from July 14th through the most recent session, the longest uninterrupted run since October of last year, pulling in a combined total of approximately $981,200,000 over that stretch. Put those two numbers side by side with the fear covered in Section 2. Retail holders are asking whether they should sell before a fork nobody has fully explained to them. On the exact same day, regulated institutional vehicles moved $69 million of net new capital into Bitcoin as part of a 7-day run approaching $1 billion. Whatever conviction is driving that institutional flow, it is clearly not being disrupted by fork headlines, at least not yet. It is worth being honest about a wrinkle in this story that most coverage of the inflow streak leaves out, because leaving it out would make this section dishonestly one-sided. According to analyst Axel Adler's data reported alongside the inflow figures, the ETF cohort's aggregate realized purchase price sits at approximately $84,714, meaning the average dollar sitting inside US spot Bitcoin ETFs right now is underwater by roughly 22% at today's price. The institutions buying today are not buying from a position of comfortable realized profit. A meaningful share of them are averaging down into a position that, in aggregate, is still showing a paper loss. That detail does not cancel out the inflow number, but it changes what the inflow number actually represents. This is not smart money celebrating a win. This is capital continuing to accumulate through a stretch where, by its own aggregate cost basis, it has not yet been proven right. That distinction matters because it reframes the entire contradiction this video is built around. It would be one thing if retail were panicking while institutions sat on comfortable gains, untouched by the same uncertainty. It is a meaningfully different thing when both retail and the aggregate ETF cohort are sitting inside the same uncomfortable, underwater adjacent stretch, and one side is responding by asking whether to sell before a fork, while the other side is responding by adding $69 million on a quiet Thursday. It also helps to put this specific streak into its own historical context, rather than treating it as an isolated headline. According to the same Sentiment reporting, the last inflow streak of comparable length occurred in early October of last year, at a moment when Bitcoin was climbing toward what would become its all-time high near $126,000. That is worth sitting with directly. A streak of this length and character has, at least once before, preceded a continued push toward new highs, and Sentiment's own analysts noted that current ETF behavior supports at least the possibility of a run towards $70,000. But the same reporting is careful to flag the opposite risk directly. A sudden, sharp spike in single-day inflows, rather than a steady, grinding accumulation like the pattern seen this week, can itself be read as a sign of an excessive fear of missing out among institutional allocators, the kind of behavior that has, historically, coincided with the formation of a local top rather than the start of a larger move. In other words, the same dataset that supports today's cautiously optimistic rid is also the dataset responsible on its own methodology for flagging when that optimism has become overextended. Reading the streak honestly means holding both of those possibilities at once, not selectively, quoting whichever one fits the narrative you already believed walking in. A single day's inflow number, even stacked on top of a 7-day streak, is a flow statistic, not a valuation statistic, and it says nothing on its own about whether current prices are fair, cheap, or expensive. Inflow streaks have reversed sharply before, and the same sentiment reporting cited above explicitly notes that a sudden spike in one-day inflows can itself be a warning sign of excessive fear of missing out rather than durable conviction. An ETF cohort sitting on a 22% aggregate unrealized loss is also a cohort with a real incentive to keep the price from falling further, which is a fact worth being aware of, not a reason to assume institutional buying is purely disinterested long-term conviction. Two specific posts from the past 24 hours are worth walking through directly, because they frame today's split from two very different angles. Michael Saylor, posting from Strategy's official account, announced what amounts to a new reporting language for the company's Bitcoin holdings, writing that Bitcoin capital markets require a new financial language, and that the company has refined its metrics to measure Bitcoin, digital credit, and digital equity with greater precision, introducing figures like net BTC, net BPS, BTC hurdle ARR, and BTC floor ARR, now live on the company's own site. Coming from Saylor specifically, this lands differently than it would from almost anyone else, given the context covered in prior coverage from CoinDesk and cryptonews.com.au. Saylor spent much of July publicly rejecting the BIP 110 soft fork covered in Section 2, describing it in one widely circulated post as a bigger threat than the spam problem it claims to solve, while Strategy itself has paused new Bitcoin purchases since June 22nd and sold portions of its position specifically to cover preferred dividend obligations, according to reporting from U.Today and Bitcoin.com News. In other words, the same account leading the public case against fork-related fear is simultaneously the account most publicly grappling with its own funding math on a Bitcoin treasury holding over 843,000 coins. That is not a contradiction that invalidates either position. It is a reminder that even the most visible, most bullish public Bitcoin holder in the world is managing real, specific financial constraints in the background, not simply reacting to price with pure conviction and nothing else. Luke Gromen posted in a pattern he has returned to repeatedly this year, framing the current macro relationship between the United States and China through the lens of the stages of grief, describing the shift in public and policy sentiment as having moved from the denial stage to the anger stage. According to the archived pattern of Gromen's posting captured by Twicopy, this is not a one-off metaphor. It recurs across his commentary on the U.S. fiscal position, connecting Bitcoin's relevance directly to what he frames as an unwillingness among policymakers to make the structural fiscal choices required, a framing that positions Bitcoin, in his view, as a hedge against exactly the kind of slow-moving macro dysfunction that does not show up in a single day's price candle at all. Neither post is about today's specific price move. Both are about the structural backdrop that today's price move is sitting on top of, and both come from accounts that a meaningful share of the people posting fork, panic, and dip fatigue in the comments today are actively following, and in many cases, reacting to indirectly without fully realizing it. It is worth naming the specific gap between how these two accounts communicate and how the retail comments covered in Section 2 communicate, because the gap itself is informative. Saylor's post is dense with new terminology. Net BTC, Net BPS, BTC hurdle ARR, BTC floor ARR, language built for a specific, sophisticated audience of analysts and institutional allocators trying to model Strategy's capital structure precisely. Gromen's post compresses a multi-year macro argument into a single evocative phrase borrowed from grief psychology. Neither one is written in the emotional register of a comment asking whether to hold both coins after a fork or describing a hangover after a red candle. That is not a criticism of either group. It simply means the loudest voices retail holders are indirectly absorbing information from are not actually speaking retail's emotional language at all. They are speaking in balance sheet metrics and macro-historical analogy, and something gets lost or distorted in the translation between those two registers, often resurfacing downstream as exactly the kind of undifferentiated dread covered earlier in this video. Saylor's new reporting metrics are, by design, favorable framings of strategy's own financial position, produced by the company being described, and should be read with the same scrutiny any company's self-reported metrics deserve, regardless of how established the messenger is. Groman's macro framing, however internally consistent, is a thesis about multi-year structural dynamics, and a multi-year thesis provides no specific guidance about what happens to price over the next week, the next month, or across the specific fork events scheduled for August. Here is the honest question this entire video has been building toward. Why does a genuinely quiet, sub 1% day produce this much retail anxiety, while the same day produces a fresh $69 million of institutional buying? The answer is not that retail is uninformed and institutions are informed. The answer is that the two groups are being exposed to and reacting to fundamentally different inputs. Retail sentiment today is responding primarily to narrative density, a fork story that is genuinely confusing because it conflates two unrelated events, a psychological framing that turns holding itself into a trap, and the specific cumulative fatigue of watching small green candles keep reverting to red. None of those three things are price data. They are stories, feelings, and fatigue, compounding on top of each other, and compounding narratives move faster and louder than compounding capital flows. Because a comment takes 5 seconds to post, and an ETF inflow takes a full trading day to show up in a report. Institutional flow, by contrast, is responding to a completely different input, a cost basis, a mandate, and a rebalancing schedule that does not check crypto Twitter before executing. The 22% aggregate unrealized loss sitting inside the ETF cohort, covered in Section 3, is itself evidence of this. An allocator continuing to add to a position that is currently underwater by roughly a fifth is not doing so because today felt calm. They are doing so because whatever mandate, model, or multi-year thesis is driving the allocation operates on a timescale where a single quiet Thursday, or even a full month of chop, is simply not a meaningful input at all. This is the same mechanism this channel has covered before, from a different angle. Loss aversion does not require a real loss to activate. It activates against your most recent reference point, which for a lot of holders right now is a very specific number, 66,300, glimpsed just one day ago. Herding compounds it because a fork comment with 60 replies feels like consensus, even when the underlying event it describes is a niche protocol proposal with under 1% miner support. Put those two mechanisms next to a genuinely confusing, poorly explained technical event, and you get exactly what is showing up in the comments today. Not irrational people, but rational people running an emotional operating system that was never designed to process protocol governance debates or 24-hour ETF flow reports in real time. There's a specific reason the Cocavina feeling described in Section 2 lands so precisely, and it is worth naming directly. A hangover is not the pain of the drink itself. It is the delayed cost that arrives after the moment has already passed, when there is nothing left to do about it. Watching Bitcoin creep up, feeling a small flicker of relief or hope attach itself to that green candle, and then watching it slide back into red produces something structurally similar. A small emotional investment made in real time, followed by a delayed, slightly nauseating sense that the investment was wasted. Do that enough times in a row, across enough quiet, choppy days, and the fatigue stops being about any single candle at all. It becomes a generalized dread attached to the entire act of checking the price, which is exactly the state in which a vague fork rumor or a binary sell too early framing finds its most receptive audience. The comment does not create the fatigue. It arrives at a moment when the fatigue is already there, looking for a shape to take. It is worth naming one more layer to this because it explains why the sell too early or become the story others wish they copied. Framing spreads as fast as it does. That sentence is constructed so that no available action feels safe, which is precisely what makes it feel true rather than manipulative in the moment you read it. A genuinely balanced description of the decision in front of a holder today would say something considerably less dramatic. Selling has a real calculable opportunity cost if the ETF-driven uptrend continues, and holding has a real calculable risk if the fork events in August coincide with a deeper macro deterioration. Both of those are ordinary bounded trade-offs, the kind investors weigh in every asset class, every day, without needing a binary trap to describe them. The version of the sentence that spreads on social media is not the balanced one. It is the one engineered, whether deliberately or simply through the mechanics of what gets engagement, to remove the middle ground entirely, because a holder who feels trapped keeps scrolling, and a holder who feels like they are weighing an ordinary trade-off does not. Explaining why retail fear and institutional buying diverge is not the same as proving the institutional side is correct. Institutions have been wrong before, at scale, And a rebalancing mandate that ignores short-term sentiment is not the same thing as a mandate that has perfect foresight about fork risk, macro deterioration, or any other specific outcome. It is entirely possible for the flow data to be accurately reported and for the price to still fall further. Nothing about a 7-day inflow streak or a Sailor Post forecloses that outcome. Knowing why the contradiction exists does not, by itself, tell you what to actually do with a day like today. Here is a specific 3-part way to check it, rather than simply feeling it. First, separate the fork question from the price question entirely in writing if you have to. Ask specifically, does BIP 110 or the eCash snapshot change anything about how my specific exchange or custodian handles my coins? And have I actually checked their published policy, rather than relying on a comment thread's summary of it? That is a solvable, checkable question, with a specific answer available from your own provider, not a vague, ambient worry that has to sit in your stomach unresolved for the next month. Second, check the actual flow number before reacting to the narrative around it. Today's specific inflow, 1,064 Bitcoin, $69,280,000, sitting inside a 7-day, $981 million streak, is a checkable fact available from Look and Chain and from the ETF issuer's own daily reporting. A fork comment with 60 replies is not evidence of anything on its own. A reported flow number, sourced and dated, is. Third, notice the specific bodily sensation described in Section 2, the cocovina, the hangover feeling after a small red candle follows a small green one, and treat it as information about your own nervous system rather than information about Bitcoin. That feeling is real and worth acknowledging directly. It is also, by itself, not a data point about fork risk, ETF flows, or strategy's balance sheet. Separating the feeling from the facts is not about suppressing the feeling. It is about not letting the feeling cast a vote on a decision that deserves to be made with the actual numbers sitting in front of you. None of this needs to be complicated. A short written note, checked on days exactly like today, quiet price action paired with loud sentiment listing the specific fear circulating, the specific flow number reported, and whether your own custody situation is actually affected by whatever protocol event is being discussed, converts a full day of ambient dread into something you can actually resolve in a few minutes. A checklist reduces the influence of narrative noise on a specific day's decision. It does not, and cannot, guarantee that the underlying fork events resolve cleanly, that the ETF inflow streak continues, or that today's quiet price action is not the calm before a considerably less quiet move. Treating a 3-step process as a guarantee of a good outcome is exactly the kind of overconfidence this channel has warned about before, in either direction. This is exactly why the Bitcoin Holder's Bible exists, and it's the same resource I pointed you toward twice already in this video without giving you the actual code. Now that you've seen the specific fear circulating in Holder's own words, the specific institutional flow number behind today's price action, what 2 of the accounts you likely already follow posted about it, and the honest mechanism behind why those 2 things diverge, here's the code I promised at the beginning. It walks through exactly how to separate a real checkable event, like a scheduled protocol proposal or a reported ETF flow number, from ambient narrative noise, like a fork comment thread or a single uncomfortable candle, using the same 5-minute weekly check covered throughout this video. It includes a framework specifically for days like today, when the price barely moves, but the sentiment around it swings hard in both directions. The regular price is $97, and the code Diamond50 at checkout brings it down to $47. And just like I've told you before, that comes with a full money-back guarantee. If it doesn't leave you with a clearer way to separate a real signal from a loud headline, you get every dollar back, no questions asked. Remember, this channel doesn't run on ad revenue anymore. Every person who picks this up isn't just buying a guide, they're one of the people actually keeping this channel able to keep making videos like this one. I see the diamond, and the link is in the description and pinned in the comments below. Again, the code is Diamond50, and it's live for a limited time. Bitcoin is trading near $65,500 today, down under 1% over the past 24 hours. A genuinely quiet move, sitting on top of roughly 2 weeks of broader upward price action. Retail sentiment during that same quiet stretch has been dominated by 3 specific fears. Confusion between 2 unrelated protocol events, buy P110 and the Stork eCash hard fork, both targeting August, a psychological framing that turns holding itself into a no-win trap, and the specific, named fatigue, cocovina, of watching small green candles keep reverting to red. On the exact same day, US spot Bitcoin ETFs recorded a net inflow of approximately 1,064 Bitcoin, worth roughly $69,280,000, extending a 7-day streak worth close to $1 billion, even as the ETF cohort's aggregate cost basis sits underwater by roughly 22%. Michael Saylor spent the same window rejecting fork-related fear publicly while introducing new reporting metrics for Strategy's own position, and Luke Gromen continued framing Bitcoin's relevance through a multi-year macro lens entirely disconnected from today's specific candle. The contradiction between retail fear and institutional buying is not evidence that one side is smart and the other is not. It reflects two groups responding to two different kinds of input: fast-moving narrative versus slow-moving, mandate-driven capital flow, filtered through the same loss aversion and herding mechanisms this channel has covered before. Nothing in this video should be read as a guarantee that today's ETF inflow streak continues, that BIP 110 and the eCash fork resolve without disruption, or that the underlying fear circulating among holders is misplaced. The ETF cohort's own aggregate unrealized loss is a reminder that institutional buying at current levels has not yet been proven right by price. And a rebalancing mandate that ignores sentiment is not the same as a mandate that has correctly priced every risk on the table for August. It's also worth being honest that this video's framing, contrasting loud retail fear against quiet institutional accumulation is itself a pattern that has shown up before and has not always resolved the same way. Sometimes the fear was right. Approaching today's specific split with genuine humility about which category it falls into is part of what separates a disciplined read of the data from a comfortable story about smart money always being right. Today's specific gap between retail fear and institutional buying is not proof of anything about where Bitcoin goes next. What it is proof of is that a fork comment thread and a reported ETF flow number are two completely different kinds of evidence, and conflating the volume of one with the reliability of the other is exactly the mistake this entire video has walked through from every angle. The fork events scheduled for August are real and worth checking against your own custody situation directly. The $69 million inflow reported today is real and worth weighing against the fact that the buyers behind it are, in aggregate, still underwater. Holding both of those facts at once, without collapsing into either blind panic or blind confidence, is the entire discipline this channel exists to build. Drop a comment below telling me honestly which of the three fears covered in this video hit closest to home for you today: the fork confusion, the sell too early framing, or the Coca-Vina feeling of watching green turn back to red. And tell me whether you've actually checked your own exchange or custodian's specific policy on BIP 110 and the eCash snapshot yet, or whether that's still sitting on your list unresolved. If this video helped you separate the feeling from the facts today, share it with the one holder you know who's currently more rattled by a quiet Thursday than the actual number support. Every quiet day in Bitcoin produces the same split. One group checks the actual flow numbers, the actual scheduled events, and the actual policy from their own custodian, and makes a decision, or makes no decision at all, based on what's actually checkable. The other group lets a comment thread, a translated hangover metaphor, and a half-understood fork story make the decision instead, without ever opening a single data source to confirm any of it. Today's price is around $65,500. It might be different by the time you're watching this, and this video was never trying to tell you what to do with that specific number. It was trying to show you that the loudest story circulating today and the quietest number reported today are not the same thing, and that mixing them up is worth noticing before the next quiet Thursday arrives. See you in the next one.